So we now welcome everybody to this particular webinar on interest rate future IRF. We'll be starting this webinar now, and if you have any queries, you can note down those queries and we'll be taking all the queries at the end of the webinar. All attendees will be in listen only mode and they cannot put in their question. They can put in their question only through chat option. Now these are the contents, these are the topics which we will be covering in this particular webinar. Firstly, we will be understanding the debt market, what the debt market is. Then we will be moving on to the need of interest rate futures. Then we will be covering the global interest rate future market. Then we will be seeing how the NSE interest rate derivative market operates, the contract specification, exchange, margin, etc., benefits of IRF, and then we will be taking the queries. So before moving to the interest rate future, let us first understand what is interest rate. Now, as you all know, if we talk about from the borrower's perspective, it is the cost of borrowing the money. So if I borrow the money from someone, the cost which I pay to borrow the money is known as interest rate. From the lender's perspective, it is the rent of the money. So if I am lending you some amount, the rent or the return or the yield which I will be getting from that money is interest for me. It is also the compensation expected by the lender for foregoing the opportunity to earn income from other investments. So if I am investing, it is my opportunity cost. So basically, if I have 1 crore rupees to invest, if I am not investing it elsewhere, I am giving that money to a borrower and earning the interest. So that interest component is the opportunity cost for me. It is the most important asset class in the world today, interest per se. Now let us see what are the factors affecting the interest rate. First is money demand and supply. How much money, how much liquidity is there in the system. That affects the interest rate. The monetary policy, the overall monetary policy in the economy, inflation, deflation. We can take a very recent example where yesterday the governor of RBI, Raghuram Rajan, talked about the inflation and rising interest rate. That could also be cited as the reason for the fall in the equity market which we saw yesterday. Economic activities or the economic indicator. So if the economy is rising, economy is good, the cost of borrowing or the cost of lending in the economy would be low. Fiscal deficit, the overall fiscal deficit in the economy. If the deficit is too high, there will be huge lending. If the economy is in surplus, the lending or the borrowing from the exchequer would not be there. So global liquidity. So the liquidity in the market. So we are hearing many news of quantitative easing or sovereign bonds issued by US, UK economies. Uncertainty in economic growth. So if there is huge uncertainty in economic growth, the exchequer or the central bank has to pump in money into the markets to ensure that there is no liquidity crisis in the markets. In India, RBI is the body which generally influences the interest rate by altering the liquidity in the system. So if the liquidity is more, the interest rate would be falling. If the liquidity is less, the interest rate would rise. So there are many factors which affect the interest rate in a particular economy and in the country like India per se. Now what are the factors affecting a bond price? Bond is simply an instrument wherein the borrower has a bond to pay X amount of yield to its client or to its investor at the end of the maturity period. So the bond price would be affected by interest rate. So if the interest rate is rising, the bond price will fall and vice versa. Maturity of that particular bond, it could be a 10-year bond, it could be a 5-year bond, it could be a 15-year bond. Liquidity in the spot bond market, primary auction by the RBI, and credit rating. So higher the credit rating, lower would be the bond yield, and lower the credit rating, higher would be the bond yield. Need of interest rate future. So exactly before we move on to understand the NSE interest rate future market, let us first understand the need of interest rate future in the markets. So interest rate risk can impact your assets and liabilities whether you are an individual, whether you are a corporate, institution, or a trading member person. How it can affect. So if you have a bond portfolio, if you have a portfolio which has bonds, NCDs, IRF, it would all affect the bond market. So if you have bank fixed deposits, if you have some fixed deposits, interest rate would affect you. If you have some investment in a debt mutual fund, so if you are investing in an FMP or a pure debt mutual fund or a balanced mutual fund wherein the balance of equity and debt is there, or a dynamic asset portfolio fund wherein the dynamically asset mobilization is done, or if you have taken a home loan, this is a huge impactor for the retail salaried person. If you are an investor of a tax-free bond, so interest rate future would affect you in every way. If whether you are investing in Bank Nifty also, it would affect you. So the basic point is that if you are living in a country and investing somewhere, interest rate future would affect you in any which way. So whether you are investing in an equity market or a bond portfolio or a housing loan customer, interest rate would affect you. And this is why the need of interest rate future was being felt and the interest rate future was launched. Now as you can see in this particular slide, what we have done is we have plotted a chart between Bank Nifty and a 10-year bond. So as you can see, let me explain you with the example of a highlighter. As you can see, when the 10-year yield bond is rising, the Bank Nifty is falling. Again, here you can see there is an inverse relationship. Here the relationship is highly inversed. So you can clearly understand the need of interest rate future even for an equity market trader. So an equity market trader can now easily hedge his trading position with the interest rate future on the same NSE exchange, and he can trade in both the directions. So whether the interest rates are rising or whether the interest rates are falling, he can earn in both the ways. The spend margin is too less, almost 3 to 4% or 5% of the contract value. 2000 is the lot size. So this is how you can convince your equity, commodity or currency clients to open the IRF account and trade in the IRF account. This is the next slide. On this slide, we'll be seeing the global perspective of the whole markets. As you can see, in 1977, CBOT introduced the first 30-year treasury bonds in the world. Then it introduced 10-year, 5-year, 2-year, 30-year ultra treasury bonds. So currently at the year end in 2012, it had $91,470 billion of outstanding principal. Although it was a decrease of 9.5% as compared to 2001, but it's a substantial amount to have. Now let us see how the trading is done in NSE interest rate future market. So there are currently two bonds which were launched on 21st of January. 8.83 GOI 2023 maturing 25 November 2022 and 7.16 Government of India 2023 bonds. Market type is normal. This is how the symbol would be. So an 88.3 government security bond would state as 883 GS 2023. It simply states that the yield is 8.83%, government bonds expiring in 2023. Instrument type is future interest rate currency. Lot size is of 2000 bonds. So this has to be cleared that the lot size of every bond is 2000. Now the price is based on the physical spot market trading on that particular bond. Contract value is quoted price of one bond into 2000. Tick size is 0.0025, which is similar to the currency derivative market. Monday to Friday 9 AM to 5 PM. 3 contracts are there, 3 monthly contracts. Expiry days last Thursday. If it's a holiday, previous trading day, similar to the equity markets. A 3% initial circuit price and 0.50% would be relaxed after 30 minutes for two times. 25,000 crore is the exchange level overall market wide position limit for banning this particular contract. Now the span margin which the exchange would charge, which is VAR, is 1.5% plus the broker's risk margin. So you can clearly assume the margin which currency derivative has, the same margins or the same initial margin or the span margin is there in the interest rate future contracts. And the interest rate future contracts are traded on the same currency derivative platform of National Stock Exchange. Daily M2M on T+1 basis. Now the final price settlement is based on NDS-OM. This is the physical RBI's National Debt System operating market, wherein the physical trading is being done by the institutional and banks on the Government of India securities. Now any client which has a currency derivative segment account can get its IRF account enabled by the exchange. They only have to fill a simple KYC form. So how they can do? So any client who wants to trade in the IRF has to select a trading member, complete the KYC agreement, pay the margin, and now it is ready to trade from the market. So it is very, very simple, very, very easy for a client to come in and trade. Now this is how the clearing and settlement takes place. Trade modifications and give up of approval of CP trades is till 5:30 PM. From 6:30 PM the back office work of the NSCCL starts. The pay-in payout happens at 8:30 AM T+1 day. Expiry is +1 day, and the client margin reporting till T+5 day, which is done by the trading members. Now this is how the spot market operates. This is the NDS-OM market by Reserve Bank of India, and this is how the trading happens in that spot market, where the spot delivery of those contracts can be taken. Now let us see what is the advantage of a trader for trading in the interest rate future as compared to the physical market. So assuming the same contract 7.16% GOI 2023, September 2013 is the expiry. The trading price is 89.68 and 89.79 in the future market. Assuming he has 5 lakh rupees to invest. In the spot market it is 100% delivery based, so he has to invest the whole 5 lakh rupees. But in the future market he can leverage and buy the one contracts worth 1 crore, assuming it's a 5% margin. So here he buys the bond in spot market by paying 100% margin. He pays 5% margin. He traded on traded on October 7, 2013. Squared off his position at these prices, corresponding prices. So in the spot market, he has earned only rupees 3246%, which is 0.65% in 7 days. But in the future market, he has earned 49,000 rupees because of the leverage with the same 5 lakh rupees investment. So the same 5 lakh rupees investment, the ROI on the spot market is 0.65, and in currency future, in the interest rate future, it is 9.80%. So you can clearly see the difference, and you can convince your client that why he or she should trade in the IRF market. So these are some benefits which are enumerated here. It is cash settled. The trader does not have to pay or does not have to give the delivery of the bonds. A contract is based on a single bond. It is easier and cheaper access to rates. You only have to open a currency interest rate derivative account with the broker and go out and trade in the markets. Centralized clearing and the guarantee settlement is guaranteed by NSECL. It is useful for all type of investors. The margin are based on actual volatility. So if the volatility is less, the margin paid is less. STT is not applicable. Only SEBI turnover fees is applicable on the contracts. So this was a brief presentation on what interest rate futures are, how the interest rate future operates, how the whole system of interest rate futures are done, and how the traders can trade in the IRF contracts. Now we are opening the forum for any questions if you have. So if you have any questions, you can type those questions in the chat room and we'll be more than happy to answer those questions. Please ask your queries if you have. This is the new exchange, new segments. So I'm sure that you must be having many queries. Feel free to ask your queries if you have any queries. Please feel free to ask your queries if you have.